Good afternoon and welcome to Charting Points, a technical look at ag markets. My name is Brian Como. Today is Thursday, October 26th. All right, we're trading futures and options. Just got to read through this disclaimer here quickly. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties express or implied as to the accuracy or completeness of the statements or any information contained in the material, and any liability, therefore, is expressly disclaimed. Past results are not necessarily indicative of future results. All right, we're going to start off today by talking a little bit about unrelated macro markets. I just kind of want to illustrate here, the main point I want to illustrate here is that we are moving into more of a risk-off environment in some aspects of the market, and equities and some other parts of the non-agriculture market are a big part of that. So I just kind of wanted to showcase that first, because sometimes ag commodities or just commodities as a whole do get kind of sucked into this risk off because there are a lot of commodities in things like ETFs, exchange traded funds, in baskets of assets, and things like that. So sometimes there is a negative impact on general market sentiment, or there is a correlated impact on general market sentiment to the rest of the commodity index. So I just wanted to run through those quickly here. This is the S&P 500 futures. Took a big hit today. It did move down below that 61.8% Fibonacci kind of retracement level. I think this is probably getting close to what you would call correction mode. How they define a correction is 10% off of the highs. And I didn't do the exact calculation, but I did see something in another periodical that would suggest that we're in corrective mode here on the S&P 500 or in the stock markets in general. Now, the S&P 500, of course, I look at that as kind of the general barometer of the market, particularly in what we would call blue chip stocks or large cap companies. When you look at some of the other markets like the NASDAQ, these are more specialized towards tech sector. Now, I believe the tech sector is kind of responsible overall for the poor performance of both this index, the NASDAQ, as well as the S&P. A lot of those companies are in both. So it's kind of like a similar indicator, but we saw some, I think some missed earnings or maybe out of Facebook or Meta in this last week, as well as some softer guidance maybe for Alphabet or Google as well. So the tech sector is taking some pretty heavy losses, and I think it's driving some risk dollars out of the market and creating a little bit of fear. One of the fear indexes as well is gold. I'm going to run through a couple of different markets here that we don't talk about very often. This one's gold. Not reaching new highs yet, but we are definitely seeing that gold, which is kind of a safe haven commodity, is been on the rise, coming up to challenge that previous high at about $2,000 an ounce. So that is kind of a confirmation signal that investors are running to safer havens in this marketplace. Here's the US dollar index. This is also a safe haven play. Now, we saw a big run up here when when the interest rate story was kind of coming to its capitulation point, and then the market has been selling off as there has been weaker guidance from the central banks and about holding on interest rates and things like that. But now in the last couple of days, we've kind of seen this resurgence, which I believe is kind of a safe haven seeking investment opportunity. So we are seeing some gains in the US dollar as a result of that as well. Here's kind of, this is an interesting one. So this is the 10-year note. So this is the value of bonds. Now, in a rising interest rate environment, bonds decline in value because in order to get the larger yield from previously issued bonds, that means that the value of those bonds need to decline. And so today, though, if you can kind of see this one little candle here, is it moved towards lows earlier in the session, but then rebounded. And you can kind of see that exact same thing happen. And this is the 10-year note yields. So it kind of ran up towards that $5% level and then peeled back down to about 485. That is also a signal of risk. So I'll back it up here for a second. When money seeks safe havens, bonds are safe, right? So if you want to tap into the yields that you can get from bonds, if you want to grab that 5% yield from the bond, you need to own the bond, right? So that's why we are getting a bit of a bid in the bond market today, and a equal downward move in the bond yields today, just because there is some chasing of a safe haven. Hopefully that makes sense. But that's all I'm going to say really about the macro markets. It's just kind of a bit of a risk-off sentiment. I don't necessarily think this is playing into the ag markets, at least today. But if we start to see broader sell-offs, and even if funds and active traders are needing to raise capital in order to fund some of the losses that they're seeing in some of the other markets, they may turn to the commodity markets. So it might be a bit of a delayed response. Just wanted to put that out there in case something like that does happen. All right, kind of moving into the ag markets here now. Corn had a bit of a rough day. This support level down here, it looks like it's likely that corn is going to come back and test this support level. That is around 467.75. You can see the last week has been relatively punishing to corn after a bit of optimism as we ran up to about 508 last week, giving us the thought that this bear market was over, and that didn't seem to be the case. So we've kind of broken down below all of these moving averages again, the 20 and the 50. I think a test of that 467 is possible here. At this point, I think that's relatively strong support. There might even be some support before we hit that level. Just south of that area, 473, 475, maybe even, today's 478 test is the next one. If we do produce a higher low here, if this kind of cements itself as a higher low and starts to move higher, we might actually be able to expect a higher high, right? So this pattern that we've seen since mid-September has kind of been for, higher highs, higher lows, that kind of thing. We saw a bit of an outsized higher high here. And if we see a bit of an outsized lower low here, that means that we could eventually grind back to, a little bit more, better values, or at least come back in to test that 505, 510 area at some point. Now, all bets would be off, though, if we do break below 467. That would be the support that we'd be watching for further bearish signals in this market. Soybeans are also kind of jostling around into the end of this week, closing at about $13 even on the January. And as you can see, it's been trading pretty tightly around that 20-day moving average here. Again, if this little pullback produces a bit of a higher low, and we start to move higher again, and we start to best this high, that would give me some confidence that we're in a bit of I'll call it a grinding bull market higher. So not a charging bull market, but more of one that needs to grind higher. And a lot of bull markets are like that. Not that I'm calling this a bull market, but bullish moves can often be relatively grinding, where the bearish moves can be relatively quick. And so I think that's what we're seeing in here. The pressure, of course, comes in from the South American crop production. They've been receiving some rains in the last week, particularly last weekend. Some rains are getting built into the forecast, and the production looks a little bit better in South America. I think the market is taking some cues from that. However, there are some parts of the market that are also very bullish. Soy meal has seen an amazing rise through the month of October. A lot of that has to do with Argentina and their shortness of product, which means that at some point in November, it's likely they may go no bid because of no product in the month of November or early December. I think most of the U.S.'s crush supplies are only going to be able to come online in January, so there might be a bit of a gap there. That's why we saw this large rise in soy meal futures, and that's been putting a bullish tilt into the soybean market. So there's kind of this tale of two stories here where soy meal, largely because of South America, is rallying and keeping soybean prices elevated. But the next crop that's going to come off into the next year is seeing some rains and is growing or potentially growing in size. And that is putting a bit of a bearish tilt on the market. So it's kind of a tale between two binary situations there. Here is the soybean oil chart. Now, this is one that doesn't look very friendly to me at all. You know, we've kind of been seeing the opposite here. We've been seeing lower lows and lower highs. I do believe, as you can see, there's a 20-day moving average that is tracking extremely closely right now to this trend line. I think if we can muster a move above that trend line, that would be a good technical signal, and we might see some move higher. However, right now, this is still tracking lower, and I would still see a significant amount of technical risk here in the vegetable oil complex. Now, kind of moving into canola, canola had a hard day. It was up $5, $6, $7, depending on the month today, and then lost all of that into the close and closed right near that support level at about 680. So I think that, that could be turning into some key support here now. Not that it's, lines up with any other support on the chart here, but if we see a double tap of that 680 area and a rise higher, I think that would cement that as being a bit of a support level. However, as you can see, all of the support levels have just been broken really easily here in the last little while, and we continue to see the moving averages continue to move lower, and we are currently seeing the 50-day start to cross over the 100-day. That's a bearish moving average cross as well. So for all intents and purposes, this market continues to look bearish from a charting perspective. Here's a soybean crush margin. Now, I'm kind of mixing the two oil seeds together here, but just wanted to kind of show you what's going on in the crush market. So crush margin for soybeans, this is the December, kind of reached new highs today. Now, I'm not sure if the December is the right one to look at because, of course, it looks the most bullish, which in theory should generate some additional crush demand. But I think it's probably better to look at the Jan, which I still think looks really, really good. We've seen a big reversal here from the 9th or so, or 8th or 9th of October into today. With big gains in the crush margin. Of course, this comes from the soy meal advances. Soybeans are crushed largely for meal or mostly for meal. So the meal right now is having an outsized effect on the soybean crush margin. But that's a good thing. I think that this is incentivizing particularly U.S. processors to continue to crush because there is profit even as the soy oil portion of the complex declines. Now, here's what that oil share of the crush margin looks like for soybeans. It dropped to 38% today. As you can see, earlier in the summer, it was up around 45% when veg oils were strong. And even through most of that harvest season, we were talking 40+% of the value of the soybean crush was coming from the oil aspect, even though only 15% of the bean produces oil. I also got asked yesterday when I was talking with advisors about this, about the canola crush and why a meal rally wouldn't be affecting canola as good as it is for beans. And that's simply a calculation of how much oil is in the canola seed versus beans. Now, canola still produces more meal than it does oil. But when you do the calculations, the oil in the canola actually works out to about, yesterday I did the calculation, it works out to about 68.6% of the crush margin of canola oil is attributable to, here I have a chart for this actually, 68.6% of the canola crush margin is attributable to oil and not to meal. Now, so it's a significantly different market dynamic than soybeans, and makes canola significantly more sensitive to oil values and not so much to meal values. Now, we have been seeing a rise in canola board crush margins as well. This is the January, currently at about $158 a ton. This is board margin again. This is you can go on the ICE website and see how this is calculated. It doesn't factor in any basis levels or anything like that. It's not a cash crush margin basis. It's just a futures crush margin, but at least it gives you an understanding of the direction of where these crush margins are heading. So this has been strengthening, and I do believe that this is likely incentivizing some additional crush. And this, I think, is particularly for what I would call short or medium term crush. So this is, booking for January, which would probably be January, kind of February crush period. As we look out towards the March, you could see there's similar pattern, right? But we're $140 or $142 of crush margin on the March, and we are $158 of crush margin in the Jan. So, in theory, there would be a larger incentive to crush more in January. So we may be the industry may be booking up some crush margin that may get processed in Jan forward. And so I do think that as we move through this calendar year, the prospects for canola demand will continue to look a little bit stronger. Now, here's just kind of the calendar. It is an inverse. There's an inverse in the crush market, right? So January 1, these numbers here are actually the chart is delayed. These numbers are the true numbers. 161 for the January, 145 for the March, 136, 130. You can kind of see how the crush margin diminishes as you move forward in time, which means that there is actually an incentive to pull the crush forward to the closer months. And right now, that closest month for crush would be the January. So that paints a little bit of a picture going forward for canola. Not that I think that this is not showing to be a bullish market right now, but I think what the lower prices are doing here, the reason that we are seeing higher crush margins is because of the decline in seed values, right? So most of the crush, as we ascertain, is derived from veg oils, which are not very strong, but the seed is falling faster than the vegetable oil and meal calculation combined, which is creating that opportunity for increased margins, which should be creating some demand going forward. So, the cure for low prices is low prices, right? Or that's kind of the adage sort of thing. And I'm not saying that this is the bottom or that, that this is going to turn around tomorrow, although it might, I don't know. Bottom line here, the January canola chart looks very bearish right now. I wouldn't be betting long on this at this point or positioning myself long in any way at this point, unless you're using floor pricing strategies in this market. If you are getting nervous about this market, that's what I would recommend is floor pricing strategies, because I do think that having upside exposure will be important. I know that, in some situations we can get into an emotional state where we just say, sell it and I'll be happy. I'm still profitable. That's probably true. But if you can think forward about how you're going to feel if the market rallies, because let's say there is a large crush demand that gets pulled in because of these low prices, and the prices start to recover, even if it's, in late December or January or something forward in 2024, if you're going to feel that tinge of regret that you sold too soon, then you need to be using floor prices in this market. Okay, we'll end off with the grain side of the market. We did see some gains in the wheat market today. As you can see by these charts, they don't really change the outlook of the charts right now. We're still more on a neutral trending market right now in these wheat markets. Chicago caught a bit more of a bid today. There was some news out of Ukraine that the safe corridor was going to be closed because of threats from the Russian Air Force, but there was also reports that was false and that ships were continuing to move through the corridor. It's one of those things where you don't know what to believe. I don't think that the market, I think the market priced that in today to some degree. I did also hear that there were some additional purchases made of US soft wheat from China. So that would explain why Chicago caught a good bid today. Uh, and and so these wheat markets kind of finished in the green. Kansas is one of those ones that actually punched a new low today. This is another one of those markets that continue to look bearish here. Punched a new low today before recovering. It did recover in the green, but this market continues to look scary, still pressured by particularly Russian values. We haven't seen those turn over yet. There's still a glut of supply of wheat in the system with newly harvested grain. Russia is just wrapping up their harvest now. And so this is the time of year where there's a lot of wheat available to the marketplace. Makes sense that this is kind of when prices get some pressure on because of that large Russian crop and its 12 and a half protein kind of grading. Kansas is getting the worst of it here. Minneapolis, similar to Chicago, saw an up day. We're still kind of in the middle of recent trading ranges, hugging that 20-day moving average at this point, and looking more neutral than anything. However, gauging by the Kansas, I would call the whole wheat complex neutral to bearish, but I wouldn't be getting overly bearish until Chicago starts making new lows, and it's a little bit away from that at this point. All right, last chart here, December oats. We are reaching that $4 level again on futures. That corresponds very closely to the 20-day moving average. I do believe that that might look like a selling opportunity to funds and to some others. So as it reaches up towards that, as it kind of did today into the close, we may see a bit of a reversal on this market. So if you are looking to sell some oats, particularly oats that have some exposure to futures, using that $4 area or this rise today might be a good opportunity for you to do that. Again, cash markets aren't necessarily correlated to the futures. I do think there's still some weakness to come in cash markets as a result of the drop in futures, but it's kind of a slow leak, and that's what we're seeing. I think for the most part, I think farmers have turned off the tap as far as selling goes. So what we need to see is some demand come into the market, into the cash market before we see gains in that market. But I do believe that we might see some selling pressure on the futures as we move through the rest of this week, or into early next week. All right, that is all we have for you today. Thank you again for joining us. We will see you again for Charting Points next Tuesday. Have a great day tomorrow. Have a great weekend, and we'll see you again next week.